Have you noticed your rent renewal feels like a surprise pop quiz and your grocery bill keeps losing its discounts? It's tempting to blame one obvious villain. But the real lever is often an invisible interest rate, the price banks pay to borrow dollars overnight. Think of dollars as the air of global trade, and funding spreads as the humidity that makes everything feel heavier. When that dollar funding engine tightens, banks quietly raise wholesale funding costs and hedge costs, like a landlord's mortgage suddenly getting reset behind the curtain. That hidden reset changes refinancing math, working capital lines, and even shipping insurance pricing. Then the impact walks into your living room as a rent increase and into your cart as higher landed import prices. So the mystery isn't just inflation, it's liquidity, the unseen plumbing of money. Here's the twist. Your rent and groceries aren't set only by local demand. They're also priced by a global dollar funding engine. When the Fed changes the reward for holding reserves, it nudges the whole system's funding temperature. Banks then pay more for wholesale dollars, like paying extra for water pressure in the pipes. That extra cost travels through mortgages, business credit lines, and currency hedges, quietly, but everywhere. To see the pressure, you don't need conspiracy theories, just balance sheets. The Fed's weekly H8 release aggregates U.S. banks' liabilities, including large time deposits and other borrowed money. Think of H8 as a dashboard showing when banks lean harder on wholesale funding. Put that next to policy rates like IORB, and you can watch funding stress build. And when that stress rises, lenders reprice credit before you notice the label at the store. Let's open the wall and look at the pipes. The global dollar funding engine. The Fed sets a key reward rate for safe dollars, and that shifts the whole room's temperature. Banks feel it first in wholesale funding costs and in the extra fee to swap local currency into dollars. That fee is the hidden variable, a spread that widens when risk rises, like a narrowing hose. When the hose narrows, lenders reprice mortgages and business credit lines before consumers see any headline. This is why a rent renewal can jump even when your neighborhood feels unchanged. Now zoom into the bank's balance sheet, because that's where the pressure shows up. The Federal Reserve's weekly H8 release aggregates U.S. commercial bank balance sheets, including large time deposits and other borrowed money. Those categories are like a bank's wholesale gas tank, and rising reliance can signal funding strain. Put that next to policy rates like IORB, and you can see why banks start paying up for dollars. Higher bank funding costs become higher loan rates, even if the borrower never touches a dollar bill. Next comes the transmission. Landlords refinance, and the math changes when the funding spread and hedging cost rise. A landlord's break-even rent is quietly tied to their loan reset and refinancing premium. For businesses, the hidden variable is working capital pricing, which hits inventory like a timer speeding up. Importers also face higher FX hedge costs and shipping insurance, which raises landed prices before any sticker changes. Then promotions shrink, shelves get cautious, and households feel it as tighter budgets and more volatile weekly bills. The common story says, your rent rose because your neighborhood got trendy. The hidden variable is refinancing math, driven by banks' wholesale dollar funding costs. When funding spreads widen, lenders reprice mortgages and commercial loans, even if local demand is flat. Landlords then face a higher reset rate, and rent becomes their pressure release valve. What feels like a local rent hike is often a global funding engine change. The common story says, groceries got expensive because stores are greedy. The hidden variables are FX hedge costs and shipping insurance, which rise when risk premia rise. That raises landed import prices before any cashier sees a new label. Then, working capital lines tighten and inventory turns into a hot potato nobody wants to hold. So promotions shrink first and your bill climbs later. If you want proof, don't start with headlines. Start with plumbing gauges. The Fed's weekly H8 report aggregates U.S. bank balance sheets, including large time deposits and other borrowed money. Those liabilities act like a bank's backup fuel tank when wholesale funding gets pricey. Compare that pressure with policy rates like IORB, and you can see stress before it hits your lease. The misconception watches prices. The reality watches funding. Before your next lease renewal or supplier quote, draw a simple map: cause, pipe, and price. Cause is the Fed's reserve reward and risk premia. The pipe is banks' wholesale funding and hedge costs. The price is your rent reset, fewer grocery promotions, and tighter working capital lines at work. Now use 3 gauges, not guesses: IORB, the Fed's weekly H8 liabilities, and your local FX hedge quote. H8 shows big buckets like large time deposits and other borrowed money, a hint of wholesale funding pressure. If those gauges rise, watch 2 signals: landlord refinance talk and shrinking store discounts.